Fox, let's get you the big story of the morning. Russia seizing Europe's largest nuclear power plant from Ukraine overnight. Oil prices up nearly 2% on that news. Joining us right now is Jeff Currie, Goldman Sachs' global head of commodities research. We've been talking about it all morning, Jeff. It is, it's a tragedy what's happening over there right now. But we are looking at oil continues to spiral upwards. The question at the moment is, does it continue apace? Is there some off ramp you see here? How do you handicap this?
Well, clearly, the situation is deteriorated, and as long as there's uncertainty around a conclusion on this outcome, the risk is to the upside across all the commodity markets. That's not oil, but coal, wheat, aluminum, copper, all very much exposed to what's going on. I think the one that's more worrisome is wheat. You got 20% of the world's wheat exports come out of Ukraine. So no, the situation was bad coming into this because you had very low inventories, very little spare capacity, and not a lot of responsive supply to the higher prices. You put that together with this disruption that is potentially the largest disruption we've ever seen in commodities, creates a lot of upside risk here.
So that's the upside risk. Is there any downside risk at all? I mean, when you sort of think through the various permutations of how this situation could unfold?
Well, in terms of thinking about, obviously the biggest downside risk here would be, a peaceful conclusion, which I think we all hope for. But as each day that this drags on, that becomes, more elusive. And obviously, whether if it was, actually, I like to take, what the betting markets are putting the probabilities on. They put a 10% probability that Biden and Putin speak, and they're putting somewhere around a 25% probability of a regime change. You put those two together, that's suggesting there's a 35% probability to a peaceful conclusion here. I don't want to make my own predictions on this beyond my capabilities, but it tells you that, even looking at these broader markets, that the probability of this thing dragging on increases. And I think, the longer it goes, the higher the probability that oil and commodity exports go to zero. Because when you think about the idea of a central bank asset freeze in the context of an energy carve-out, the two cannot coexist. They're incongruent. So I can't come up with a sustainable outcome where you have both simultaneously, which suggests that the risks are very much skewed to the downside on exports of commodities, which then skews the price risk to the upside.
So if you're Jay Powell, how much are you worrying about stagflation?
Well, when we think about the risk here really are, confined to Europe. Europe, is the one that's the most exposed here. They're the ones that import the most hydrocarbons. You look at the United States, it has, obviously more than enough gas. Gas prices are relatively low. You look at oil prices, even at $110 a barrel. Historically, we're not even close to being at the highest levels. In contrast, you look at European prices in euros per barrel, we're at all-time highs right now. So, what's really different about this crisis than ones that we've seen in the past is that it's Euro-centric as opposed to U.S.-centric. Think about all of these other energy crises we've experienced over time have really centered in the U.S. That's what really makes this one different is it's more of a European problem than it is a U.S. problem. And I think, that was clear in Powell's message in this, this past week.
But how much does it flow through? The problems in Europe flow through to us. I think you're seeing it in our markets. Is that not? I mean, it's reflected in the markets. Should it not be?
Well, no. If you think about the U.S., if it is balanced on an energy basis, it's a wealth transfer between the producers in Texas and the consumers in the North. Looking at the U.S. as a whole, movements in oil prices are not that significant. The reason why we have it in our head that a sharp rise in oil prices are bad for the U.S., like during the 1970s, is because you think about the U.S. being short and that wealth transfer was between the United States and, let's say, the Middle East. This time, the wealth transfer is domestic. as opposed to being foreign, which is very different. Yeah, I mean, there are issues around the inflationary pressures that are being created here. But let's remember, look at natural gas right here. What that you're putting up right now, it's $4.86. I don't even know where in Europe it is right now, but it's around probably $50 an MMBTU. It's 10x what it is on the screen here. That tells you the difference of the magnitude that you're dealing with in Europe relative to the United States.
You should just get into the short-term export business. Well, you and me.
By the way, you got to build that liquefaction terminal. That takes time.
Yeah. So, Jeff, we could, if we said right now we're not buying another drop of Russian oil, we could do that. From what you're saying, it's not gonna, that wouldn't kill us. Would that help? Would it work? Would it hurt Russia? How would that? What does that look like, and do you expect it to happen?
Well, I mean, at this point right now, you're almost sure to go that direction. And the reason why is, let me ask you this. Do you want to take a ship up into the Black Sea right now? Can you get a crew to do it? Can you get the insurance to do it? Can you get the commodity trade finance to do it?
So it's happening anyway, huh? We might as well do it then. Yeah, happening anyway, so we might as well do it then and make the statement.
It is all pretty much happening at this point.
And
the stuff that's flowing is what's coming down the pipelines, because pipelines are much safer.
And we're still below 110, so maybe we need to do.
That's why there's a lot of upside risk here.
There is.
Another interesting point, you look at the open interest, it's been declining in this market as the prices have gone up, which is telling you that investor participation and interest in holding energy positions is not that high despite what's going on. So this rally has really been driven by commercials and corporates rather than by investors.
Is that a weapon we can use against Russia or not? They'll sell it to somebody else if they are able to, but you're saying they can't do it anyway. So de facto, it's already happening. So it's not
already happening. That's the point. And then I think, the point about you can't really get a sustainable outcome of having a central bank asset freeze and have them exporting oil at the same time, because you have to ask yourself, what are you going to do with the surplus currency, whether if it's in euros or dollars or whatever it might be, because once you bring it back onshore, the Treasury can't touch it. I can't come up with a scenario in which you get a sustainable outcome, which means, even if you could overcome these physical impediments of going and getting this oil or these metric tons or these bushels of wheat, you still run into the problems of how do you deal with the surplus that could be generated from the export. So I like to point out, every time we have done these asset freezes, it just doesn't end very well. We saw it in Iran in 1979. We saw it in Venezuela in the 2000s. We saw it in North Korea in 2006. And when you look at the implications, production in Venezuela, look where it is today versus where it was in 2002. Look at Iran, production today, capacity is somewhere around 3.8 million barrels per day versus 6 back in 1979 before you imposed the asset freeze.
Jeff, I want to thank you for helping us try to make some sense of this morning.
Great.
Have a good weekend.
Thanks for having me.